Hi, good morning, everyone. Good morning, Sunil. Thanks for joining us today for our monthly webinar. Uh, what a month this has been, a total U-turn in terms of market momentum, but we still have some issues that are not resolved in terms of the war, geopolitics. I think Sunil will start with discussing all of that. If you have any questions, please type it in the Q&A box, and one of our team members at the end, towards the end, will take all those questions, and we'll be more than happy to answer. And with that, Sunil, the floor is yours.
War having shifted to a economic war from a military war, I think is one of the positives that we can look at it. Because one of the fears here, and if you look at it from, I'm purely talking about this from a US perspective, because Israel has its own reasons and will not rest until it achieves significant degradation of both the Hezbollah capacity as well as the Iranian capacity. That's different. Israel is not so concerned with the Hormuz trade or the oil prices. So coming from American perspective, clearly the shift from a military to economic escalation or fight on the economic front has been driven by two, three things. One is the sustained impact on the popularity of Mr. Trump from the oil prices, gasoline prices going past the $4. It's almost a 40% increase in oil prices and another 25 in diesel. So his popularity ratings have been going down, and the context of a midterm election a few months from now means that that's something that we need to worry about, and hence consequently the decision not to pursue it, boots on the ground strategy. Because on top of this, if body bags were to come home of US Marines, that would really hurt his image. So I think that has been one factor which has caused. The second, of course, is the actual financial cost of the war. I mean, Mr. Hegseth has been telling the Congress that it's about 25 to 30 billion, but I don't think anybody believes that number. Especially in the context, they've gone and asked for a $200 billion war-related spending power. So clearly, in a time when Trump is forced to refund the tariffs, the pressure on the US fiscal is obviously quite significant. And that's another reason that I think he's shifted to the blockade of the Hormuz Strait, because there's no financial cost there. There's no body bags coming home. At the same time, you're tightening the squeeze on Iran. Is what? Now, how this economic blockade, because it definitely seems to have triggered a series of talks, ceasefires, though there's no conclusion. But clearly, I sense that Iran is more willing to try and negotiate some kind of thing, because it's not just about a nation rising up against a US, which is a big enemy. Right? About the fact that the local food prices, there's going to be food shortage because they shut off the trade. Those impacts are not so easy to handle. So I think that why I'm pointing this out is to that extent, and it's very, I don't know if you noticed the statement that was made to Congress. The US is the war is over. Because beyond was if the war was to come, they need congressional approval. Nice way of saying the military war is over. The blockade is not considered a war. So you can see how he had to desperately avoid conflict, because the high profit to stop this war. So all of why I'm pointing this, while the oil prices clearly have risen and hurting the war itself, I think will now perspective. And there could be a possibility of two, three solutions now. That the US gets into the war, whatever be the stakes. Second is they go and physically seize the Hormuz trade, make which to make oil prices. And third is that it continues in this way for some more time, because blockade, there's big cost to the US. Let it go along. Continues its battle on the thing. So Mr. Netanyahu cancels the trip, probably gives an indication not ready to give up. The key then again, stock market and this is what's going to happen to oil prices, right? So I think the key. There's a war, like a Russia war, it doesn't matter what happens to oil prices, which is what we need to keep in mind. And so we come to the next big thing now, which is the Fed. So the Fed policy, while hold was expected, it was a hawkish hold. That was also more or less expected, because it's common knowledge that the oil price related spike is there. But what surprised the market was the division. Since 1992, the first time that we've had a strongly divided Fed. And this has caused a few flutters in terms of the fact that is a rate cut in the future going to be that easy? Because the one man appointed by Mr. Trump himself, he, as expected, voted for a rate cut. The 8 people voted for a hold, which could be interpreted either way, which means that they are on the sidelines. But the 3 people saying that they refuse to allow any language regarding a cut to come into the Fed document is the worry, right? So the markets were worried because earlier there was 1 or 2 rate cuts being priced into the calendar year. Now, immediately post the policy, it's turned down to 0, right? I'll discuss this Fed policy a bit more in detail in a later slide. But for now, what I wanted to say was that the market is reacting to 2 things now, which is the near-term wonderful. First is, of course, the oil prices not coming down, staying at about 100 and to 110. Second is, of course, is that the expectation of rate cut has suddenly diminished. So these 2 have affected near-term performance of the market, right? The third big story on which I'll also cover is the AI story, which we've been talking about, the Capex spend, and we'll let you know how that is impacting the market and why, for that reason alone, right, it's a good time to stay invested or even take a medium-term view, a positive view of the this US stock market and maybe even parts of Europe. So can we go to the next slide, Ketul, with my request? Right. So this is the Fed policy drill down. So just to remind viewers and listeners that each central bank governor has different things that they balance, right? Now in India, we know there's growth and inflation, which is layered upon with the currency there. So as far as India's RBI governor, currency, growth, inflation are the 3 things they try to balance in a way. In the US, it's different because US is a freely convertible country. It is the reserve currency of the world. So the currency is not important, but it's substituted by labor. Why is labor so important? Because US is a heavily demand-driven economy with a $90,000 per capita income. So it's a demand-driven economy. So wages correlate strongly with demand, both in terms of growth and in terms of inflation. So from a labor data, which is very, very important from the US perspective, first is the slide on the right-hand side, the top slide, which talks about the labor non-farm payrolls which come up. Now, why is it non-farm? Just to tell you all, less than 6% of US labor is employed in the farms because of the severe level of mechanization. So that really doesn't impact world, mass countrywide economic demand or supply. So from that point of view, it's the non-farm payrolls which are focused in the US. And you see month on month, it goes up, kabhi ऊपर कभी नीचे, to talk from a Hindi perspective, right? It's the whipsaw effect. So hard to draw any sustained conclusion. So January was strong. There's also no rate cut possible because if employment is strong and Fed is not worried about supporting the economy, right? And the second time, week till February, so the market swings every month based on an outlook based on this. So what we're trying to do here is to take you a 6-month average, and you see that it's just 15,000 the change in the total payroll. So very muted rate of overall economic growth, employment growth, right? So what's the looking at this? It means that employment is not rising so fast that the Fed has to hike rates to control it, right? So there is, from this perspective, it's a stable thing. It keeps the Fed neutral to other triggers to cut rates if they want. Because there's no fear that this will lead to a employment related issue. So the next part, of course, is related to employment. It's about the wage growth, right? So wage growth, however, is a major driver of persistent inflation. And for here, I would like to again, I think I spoke about it in the last month's meeting, right? The nature of the inflation is important. Now, I just spoke about US being a consumer-driven economy with a high per capita income. So wage growth is the one thing, because when you get an increment, it lasts pretty much forever. So the long-term sustained driver of inflation consistently is wage growth. So if there is strong wage growth, then the Fed would hesitate to cut rates because that would make demand side inflation even worse. And remember, when we spoke last time to say that the monetary policy largely can impact directly and immediately only the demand side of an inflation. The supply side is beyond control. Now, if Fed hikes rates, is it going to bring the oil prices down and have any impact? It will only lead to slowdown of growth. And in which way? In a roundabout way, will then lead to slowdown of demand inflation and achieve purposes. So it's not that a supply side doesn't mean that there will be no rate hike, but it's a third degree impact, because especially when that supply is not domestic supply driven, where at least some level of interest rate could cause some kind of demand supply changes. It's an imported inflation in a way. Why I'm saying that the price is imported. The US is a net exporter of oil, right? But the price is fixed internationally. So while US energy companies are probably laughing all the way to the bank here, but the key is that from a Fed perspective, it doesn't give him the comfort to give a rate cut if the wage growth is high, because then you are adding fuel to the fire, right? Because imported inflation is already high. You cut it, then what will happen is that demand side inflation will get boosted and you'll have a double whammy on inflation. So studying wage growth is very, very critical from the US perspective. And what we are seeing here is that wages are fairly stable, which is the bottom right. The graph can see we have drawn a line through to tell you that wages are more or less stable. So that's not an issue for the Fed to not cut rates, right? So this won't be a hindrance, because it's not like wages are rapidly going up or whatever for them to cool it down, right? So finally, then, what are we wanting to look at? Because as you know, the Fed is extremely data dependent, and every month and every quarter, it's the data which drives it. So what we need to see from a stock market perversely is that bad news is good news. Because we need to see a bad monthly non-farm payroll to increase the probability of a rate cut. So perversely, while that may not be good from an economy perspective, the stock markets are hungry for bad news so that they can build up their expectation of rate cut and take the markets up. Okay. So with that base of a fairly detailed discussion of this employment, let's go to the next slide and talk about the other factor, which is very important, and that is where it signs into both the labor and the wages, is that US has been growing fairly decently in terms of economic growth. In fact, the Fed has mentioned it, right? There's stable growth. Growth is not, the fears of a stagflation are now no longer talked about. That is, what is stagflation? High inflation and low growth, right? I don't think anybody is now talking about stagflation, and that word is kind of gone away from the dictionary for the time being. Now, why is this happening if labor and wages are not rampantly rising, but still US growth is strong? It's because of AI. And it's not just AI, it's the entire wider universe of AI. It's robotics, right? It's about the efficiencies in terms of 3D printing in manufacturing, right? And those things which are coming in. So actually, believe it or not, you are seeing that a strong 2.3% annual growth in productivity since the post-COVID era. So this is a phenomenal statement, because for a country with a high per capita income, with obviously high per capita wage cost, when I last saw it, per capita manufacturing cost in the US was $30 per hour compared to $4.50 in the China and what $1.50 in India, right? So it's very expensive wage economy, but if that's growing productivity, it takes off the burden of the high wage cost dramatically, and this is coming by man being substituted by machine effectively. That's why you're not seeing payrolls consistently go up, or wages also need to go up so much, right? So pre-pandemic, the average of productivity growth was 1.4. Post-pandemic, because the adoption of technology, it's a common story, right? The COVID drove a huge adoption of technology across consumption, manufacturing, all industries, and that's showing up the productivity rate. And the graph on the right-hand side, which tells you the long-term average and how productivity has spiked up, is one of the key things, which is the positive from a US economy, that it is adapting well and using this whole situation, COVID starting, to improve massively the productivity. And this is the lasting impact of AI, which is why AI is called as the fourth industrial revolution. Every industrial revolution, whether it was the textile revolution or the iron and steel shift from basic agrarian to using tools, has resulted in phenomenal productive gains, and these are something which will last for a long time as AI penetrates into a wider range of user industries. So I think that AI being labeled the next industrial revolution is not overestimating AI. In fact, it is tells you how it's going to transform our world, and hence the traditional. So I wouldn't be surprised. I'm taking a bold call here that in a year or 2 years down the road, wages may be important, but labor data may lose less, may have less relevance from a Fed perspective, because it's the productive gains are going to set off the fact of labor, right? Wages, of course, because they are related to demand, may remain a factor in the Fed's mindset. Okay, so let's keep that fact in mind that the US is growing its productivity tremendously. Right now, we come to the Fed. Right. So what's happened at the Fed? So first of all, this is the last meeting of Mr. Powell. But what's not stated in the slide, I just want to say, is that Mr. Powell continues as a governor. He's just not the chair of the Fed. So his vote will always be there as an anti-rate cut vote. Uh, too late Powell, as Mr. Trump has labeled him, will continue to be there. But that's still there. There are 12 members, of which he'll be one. Right. Now, Mr. Walsh is a very interesting case. Right. His previous tenor was actually a hawkish tenor. And so when his first name came out, you recollect the markets reacted very negatively. But I think Mr. Walsh has been pains to say that he is a person who is responsive. And at that time, his response was that way. And he's willing to be responsive to the new situation. So that is the worry about Mr. Walsh. Because obviously, Mr. Trump would not have chosen him if he was a hawk. So I think that what's happened is that he has said that he is willing to look at the data and the needs of the US. And that's why Mr. Trump has been convinced about taking him on. He should get confirmed. I think May 11th is the final confirmation, which should happen. And from his perspective, then look at the nuance of what he's saying. He is talking about the fact that he wants to cut rates but shrink balance sheets. See, normally, if you see whether it's the global financial crisis or the COVID, you saw rate cuts and balance sheet expansion, QE, as it were, go hand in hand, because they throw everything at the problem, right? They want to make money cheap, they want to make money plenty. But he is saying, no, I will nuance it, that I will cut rates, but I will tighten the balance sheet. So, which is a good way of balancing the two, because cheap money is good for people who need it, but making it free and easily available unnecessarily causes a hyperinflation in a lot of asset classes, right? So I think that his nuanced approach, right, the market will understand it. And since the rate cuts are what determines it more than liquidity, so again, another factor here, a rate cut has a more direct impact on the US economy, whereas a QE has a worldwide economy, because water finds its own level, monetary liquidity also finds its own level, and that free availability of QE goes to emerging markets and boosts markets all over the world and all asset classes all over the world. So by doing this, the curtailing of the balance sheet expansion and keeping on rate cut path, he's probably going to make sure that it stays largely within the US, the positive impact, and doesn't leak through a transmission process into the overall whole wide world. So I think that again is something that the US markets will welcome, market analysts, that impact on that will be directly positive for the US market. So that's the second thing. The third thing is that, of course, this is going to be early mid-June before his first policy comes in. He may need a policy or two really spell out. And the ending of the war is obviously something that's going to play a role in terms of the oil prices, which will continue to remain a factor in the inflationary forecast. So mid-June is the earliest now. And for the markets to change their current view, which was earlier a 50 basis points rate cut by 2026 to now zero, to factor in one rate cut, at least in, let's say, November or December policy, would be closely watching Mr. Walsh's statements, both during his confirmation and in the course of the first two meetings that he chairs, right? So I think that market today is not yet factored any of Mr. Walsh's actions at all. So they want to hear him. So why I'm saying this is a potential upside for the market, because being Mr. Trump's nominee and saying that he's openly favorable to looking at rate cuts, but market not factoring in, because the moment that realization comes through and gets reinforced in the market, you will see a market rally based on a now back on the table rate cut for 2026. So I think that again here, the lack of the good news of knowing Mr. What's his strategy is a good news. So it's not bad news, but it's the lack of, because there's no clarity on what's built into the market expectation. In that uncertain period is when we should go and invest. Because when that clarity comes through, which the probability I would say is very high, the market will then react immediately to that favorable from a risk on capacity on the equities as an asset class. Okay, so let's move forward now, right, to look at the US market performance for the year. So there's both on the table on the right hand side, there's both the euro and the S&P given there. The data is as of the 24th of April, right? And in the middle is the performance of the indices. So you can see there that the Euro stocks has done 3% year to date, up positive, and you've seen, I think, the S&P doing about 10%. 1 minute, let me just look at the data. About 4.7% year to date, right? So the first thing is that despite the war and its impact and the oil prices and that impact, on a YTD basis, both these indices are still up for the year, right? So that's the first point to take, that for the year to date, they have not yet evaporated the gains that has come through and are stable. But what has driven this positive return? That's the important point to stress, right? So it's the AI related world. We've spoken about the AI related capex, and there's a next slide will reinforce that. But before we go there, this AI related, maybe Ketul, for a minute, if you can just hop to the next slide and come back here. Because we've spoken about this, right? 650 to 700 billion dollars in capex by the majors, and we contextualize it to saying that India's largest company, Reliance, is 200 billion dollars in market cap, right? So just 6, 7 companies spending 700 billion dollars. Now, initially, when they looked at it, the ROI part of it hurt these companies, saying that they're all in a mad race like the California gold rush going behind AI capex, but the ROE is not clearly determined. And so what is it? There was an initial aggregation. But then when you realize now that it's the fourth industrial revolution and people have to invest in, there's no choice in it, right? You've got to be ready. Yes, or not all companies will succeed in this endeavor. There will be a winner who will take most of it, or a winner take all will be there. But everybody has no choice but to spend. And so if you go back to the previous slide, right, the point is that the market is already recognizing this in terms of the polarization of the market. So the old economy, which is the red, the bottom of the table, is the one which is hurting and reacting to this whole market war-related situations and everything. But if you look at the top of the table in both the indices, Europe as well as Europe, energy clearly positive because oil prices have up 50%. So energy stocks will trend. That's a very straight correlation. The second is there what? Semiconductors. A little bit down there is tech materials. And then there's capital goods, right? So capital goods, materials, tech, and semiconductors. All of these are showing the second order impact of these tech companies spending on infrastructure, right? And you naturally, this cost of this, we put 650 and gone to 700, partly perhaps because energy costs have gone up and there's energy involved in capex, right? So all of these put together are indicating that this war is not impacting this whole hyper scaling of capital expenditures. And in a post-war world, they will again be dominant, and they are the ones that have driven this positive return. So if you look at it, leaving energy aside, semiconductors are up 26% year to date in the US, right? Technology is up 8% in Europe, right? And if you look at capital goods, 15%, materials, 14%, tech, hardware, 10%. So strong double-digit growth from all this AI-related spin-off sectors, which are likely to benefit, right? This taking the market forward. So why I'm saying this is any correction that's happening in these sectors, right, during the war represents a buying opportunity, because these are the sustainable things which in a pre-war, post-war world are the part of the changing world in front of us. And hence, drilling down on these basic building blocks of the future, which is AI, right, is the right way to build a portfolio, because the war is a short-term panic reaction. Energy has shot up. Energy may come down after the war. So there is a cyclicality and there's a demand supply issue to energy. Oil prices start trending down below the $90 level, energy will show a correction. So it's a tactical play. But if you want to look at a more sustainable wealth creating process, it is to back the AI world. Yes, within the AI world, the companies which are spending it, the ROIs will be examined and there will be ups and downs. But broadly, if you are invested in that universe, the winner is likely to be in your bag, right? It's not going to be easy to pick just that only one winner and have the portfolio. But if you're investing the entire AI related universe, you're more than likely to have the winner in your portfolio and get the benefit of that from a portfolio perspective. So the next slide is again the same thing that we just discussed, just to say that so this fourth industrial revolution is going to funnel trillions of dollars into the well-positioned hardware infrastructure leaders over the coming years, right? So I think with that, I'll hand the floor over to Ketul, having given a broad picture to get down into the talks related.
Hey, thank you, Sunil, very much for the discussion on US macro. If you have any questions from the audience, please type your questions in the Q&A box, and I think Prashant from our team will take those questions as soon as I'm done with a few slides that I have to discuss. So moving on to the next slide, I think one of the frequent pushbacks that we get that, okay, AI is good, but what about valuations? And what we have realized is that there is so much media noise around the hype of AI and valuations and the stock markets reaching all-time highs. We forget the actual data for a lot of these stocks. And so I have picked the top stocks that everybody knows, right? I can talk about the index levels and all that, but here there are real examples that you will see that valuation is not actually high. So the first chart on the left-hand side is Meta. Everybody uses Facebook, Instagram, WhatsApp, right? They own all those three. That company is trading at close to its 5 to 10-year lows and potentially all-time lows in terms of valuation. So the only other time it traded below this valuation was, you can see, during the COVID times. After that, it has never traded below its current valuations, right? So valuation for Meta is not an issue. Next, the storied name is NVIDIA. Everybody talks about NVIDIA being the darling of the AI world. It is currently trading at an all-time low valuation. It has never before traded at these type of levels. Even in the pre-AI era, when it was not such a great company, it just used to make video graphics card, and that also for industry, which only for laptops. It did not make its video graphics card were not used by like iPhones or other phones. So it was only making graphics card for laptops, which was a dying industry even back then. So even in those days, when the only product it was making was not that great of a product, or was not that the growth was not expected to be that good, even in those days it was trading at a higher multiple than what it is trading right now. So two storied stocks. Let's pick another one, Microsoft, trading close to its all-time lows again, or at least compared to the last 10 years. Similarly, Amazon is an absolute all-time low right now. So whether AI or no AI, you're going to need somebody to deliver the goods to your home, right? There is no doubt about that. So this is not, it's not a loser from the AI adaptation around the world. And even then, it is trading at a very low multiple. And these are multiples from as of Friday's close. So these are not some old multiples. As of Friday evening's market close, these are the multiples, right? Similarly, Netflix, trading at an all-time low multiple again. And so the question is not, okay, one or two stocks trading at all-time low. The 5 or 7 good names, the top names that you know of in the world, all of them trading at a historic low multiple, or at least a 10-year low multiple at the same time. That is the most important story. One of them may trade at an all-time low multiple because of a stock-specific issue. But all of them trading at a low multiple means that the market is definitely not expensive. And so then the question is, then how come the the overall the value of the stock market is at an all-time high versus the valuation multiples is not there. That is because the earnings have grown at the same pace. So all of these companies have grown earnings at a faster pace than what their stock prices have grown. And that's why the earnings multiples have not actually increased. In fact, they have declined because their earnings have grown faster than the growth in the stock price. And that's the reason that there is a little bit of a mismatch about how people think that, okay, the stock markets are at an all-time high, but the valuations are not at an all-time high because the earnings have grown faster. So from a valuations perspective, we do feel that this is absolutely a good time to invest. And here's for the entire index. The blue line that you see in the chart is the stock price of the S&P 500, which means it's the actual value of the S&P 500. And the black line that you see is the forward 12-month earnings per share. You will see that they have now converged, which means for the last 10 years, the earnings growth and the stock price growth have pretty much been in line, which means if you look at the multiple probably 10 years back and today, the valuation multiples are not very different. So it shows that whatever increase in stock prices or index levels you are seeing are based on solid fundamentals of earnings. And that's why it's not liquidity oriented type of a rally. If it is a liquidity oriented type of rally, there could be a compression and you could see a lot of risk. Here, we are not seeing a lot of risk because this is not a liquidity based rally. It is more based on fundamental earnings growth. And when earnings are growing, the stock market values will go up. That's just mathematical. There's nothing of a bubble or any worry over there. So moving on to the next slide. In fact, earnings today in the post-war scenario are higher than what they were pre-war. If you look at the bottom two lines and the fourth bar chart from the left-hand side is the S&P 500, which is the US large cap index. Today, the expectations for CY26 EPS growth for the index is 17.4% year over year versus December 31st of 2025, that is pre-war, the expectations were at 15%. So after the war, actually the earnings expectations have gone up. Obviously, one of the major contributors is the third bar chart that you see, energy. It went from 6% to 26%. But even technology, materials, they have all grown in terms of earnings expectation. Technology went from 26% to 37%. Materials went from 20% to almost 29%, slightly higher than that. So these are the sectors that are contributing to higher EPS expectations for S&P 500, even compared to the pre-war era, just 3 months back when there was no war in the picture. So we are quite happy about the earnings situation. The fundamentals are rock solid. There's no issue with the fundamentals so far. These are some of the slides that I have on AI infrastructure, which I can go into details if there are any questions, but this is just too much detail into how these companies are generating revenues, which I'm more than happy to go through, but right now I'll just glance over them. This is the total enterprise spend, how it is broken into foundation models versus hardware. So it's different parts, which sectors within a company are spending, where they are spending. It's all details about that. So we have done extensive study about all the revenues which are going to give the returns. We saw the 600 billion, 700 billion numbers in Capex that are going to happen in just 2026. Those, remember, those were 1 year Capex numbers that they are spending on AI. So these are the revenues that are going to help the returns on that AI spend. So these revenues have grown significantly from 24 to 25, and they continue to increase in 26 also. So that's why there is a very good case to be made that while this Capex looks high, the revenues are being generated. It is not a free ride. It is not just a pie in the sky. There are true actual revenues being generated, and that will fund the Capex further. The thing you always want to look at is what are the margins. So the chart that you see at the bottom is the EBIT margins of the Google Cloud business. This is not the entire Google company. This is just the AI infrastructure business. They call it the the data center business, which is Google Cloud AI. So their EBIT margins in the pre-AI era were in the 2.6% range, as you see from the leftmost bar chart on first quarter of 23. That is pre-AI era. Now, after all this capex and after generating revenues from that, currently their EBIT margins are at 23.7%, which is a 20 percentage point jump after AI and after all the capex. So, if you were the CEO of this particular business segment, your view would be to continue investing in this sector, because the EBIT margins are just growing. There is no stopping. And that's why we feel that this is a very good business and the company will continue investing in this. There is no issue with this at all. Moving on to the next slide. Now, another question we frequently get is that, are we late to the AI investing cycle? Obviously, this is now the third year that we are into this AI trade. Are we late? So one of the indicators of any market getting to the top is a lot of IPOs coming into the market. The two of the biggest pioneers, OpenAI and Anthropic in this market, they haven't even gone IPO. So this is just all private money that is still funding the AI companies. Public money has still not even reached these companies. So as you can imagine, we are far away from the top of the market. Even after the IPO, a lot of times these markets keep going for a few years. And the IPOs of the top two companies are still expected in the second half of this year. So we are far away from being late to investing in the AI trade. Another important part is that we are still seeing growth. If you are late, then the growth in token generation or growth in AI usage will plateau. And at some point in time, it could also start decreasing. That could be 10 years, 15 years down the line. As of now, year on year, the growth is not in percentage terms. It has increased 13x. So when you're going through this type of growth, it is highly unlikely that you are going to plateau. Because for plateauing, that 13x needs to come down to 5-10% and then decline from there. So right now, the growth is just phenomenal in terms of usage of AI. The chart on the right-hand side shows exactly that. And the last week, the growth that we saw in terms of token generation was 13x compared to the same week last year. So we are still in a massive growth phase, and we are not too worried about if we are late in the AI investment cycle. Another question we typically get is that, is AI in a massive bubble right now? Our answer to that is an emphatic no, primarily because these companies that we are talking about, these companies are not startups, right? Google, Microsoft, Amazon, they are spending $700 billion. They know everything that you and I do. What time we wake up, what time we sleep, what time we eat, where do we go, where our offices, who our friends are, and their activities. So, and they have some of the largest number of PhDs to process this data. Most of these companies, I definitely know for sure that Amazon has more PhDs on their payroll than the entire government of United States, right? So they have the data, they have the talent to process that data, and they are spending money saying that we are able to use this data to improve people's experiences and people's lives. So if I were to bet, I would bet on them being correct than some anchor on TV telling me that AI is in a bubble, right? So the amount of data that they have, the amount of talent they have, the amount of revenue that they are generating, I would bet on their confidence more than somebody who has a view but does not have any data to support that whether the sector is in a bubble or not. And that's why we have been very confident on this sector so far and continue to be confident in the near term. We don't see any issues with it so far. And so I think those are the main points that we wanted to cover today. There are some slides now on why we should look at global investing. And one reason is country-specific risk. This is the stock returns chart of China. And you can see that even though China has grown at the GDP growth has, the nominal GDP growth has been more than 13% for 25 years, their stock market returns have been in the 1 to 2% for those same 25 years. So if you are exposed to a single country risk, this could be the outcome. For a country where their GDP growth has been phenomenal, imagine if their GDP growth faltered, this positive 1 to 2% returns could easily go into negative territory, right? So in spite of this massive GDP growth, their stock markets have not generated returns. So single country investment is always a big risk. That's why one should always diversify outside of their home country, because otherwise you are exposed to a single country risk. And you are diversifying. So typically, when you diversify your portfolio, say you are diversifying into FDs or cash or any other asset class out of the stocks, say Nifty 50. So historically, let's pick a number. Nifty has given returns of 12%. If you do FDs, your returns will be 7-8%. So that difference in return, 4 to 5%, is the premium you are paying for diversification. You want to diversify. You don't want to have 100% of your assets in equity. You are diversifying. But for that, the premium that you are paying is the insurance premium, is the lower returns that you get, 4 to 5% lower returns in terms of FDs, right? But here, when you diversify, your returns are increasing. So as they say, the only free lunch in economics, there are very few free lunches in economics, one of them being diversification. And the person who came out with this theory, Harry Markowitz, he has won a Nobel Prize in economics, primarily because of his theory, which shows that the only free lunch in economics is diversification, especially if you get higher returns from an asset class by diversifying. And that is what we are showing in this chart, that if you invested in the Nifty 50 for the last 15, 17 years since the last recession, right? Your returns would have been X. If you invested and diversified into a global or a more of a US portfolio, your returns from that portfolio would have been 2X. You're not even close. And so by diversifying, remember in the case of FD, you have to pay a premium in terms of lower returns. Here, you are getting paid to diversify. And that's the beauty of diversifying in high return asset classes outside of your home country. So that's why we do feel that these are very important points that one should diversify. And we are getting an opportunity to participate in the fourth industrial revolution at the same time. So you put those two things together, and this is one of the best times that one could invest in this asset class. And I think we'll pause over here. Prashant, if you can collect the questions that you have on the Q&A and ask a few of them, we can take it from there.
Hey, thanks for giving me this opportunity. So we have first question. If market remains flat or bearish for the next 2-3 years, how do you plan to generate returns?
Yeah, see, if market returns flat for the next 2 or 3 years, obviously our returns will also be impacted. We are a long-only portfolio, so we are not immune to market returns. However, we are investing in sectors that are growing much faster than the market. And that is why we do feel that even if the markets do not generate returns, the chances of our portfolio generating returns are pretty high. Because as long as people keep investing and growing and keep using AI, there is going to be returns, there are going to be earnings generated. And as Sunil pointed out, some of these could be cyclical, like the markets earnings may not grow and may not grow because, say, energy oil goes back to $60-70. Then the growth in energy earnings that you saw, that is cyclical, that will suffer. And because of that, that part of the market may suffer, and overall the market returns will be impacted. As long as we are invested in good growth companies, good cash generating companies, I think our fundamentals are very strong. And this is more of a secular type of a trend. It is not related to one country, one person, one commodity. This is a secular trend. We are talking about it being the fourth industrial revolution, which means its success does not depend on one factor. Like the success of energy sector purely depends on the price of crude oil, right? There is nothing, not one single factor like that, that could change the trajectory of the AI space as of now. And it's not only AI. Now AI is spinning, the growth of this is now coming into machine learning, into manufacturing, because with AI, excuse me, we are getting some warning signs over here. Because of this AI, excuse me for a second.
Nation. No action is required. The target upon receipt of this message. This is a test.
Okay, sorry about that. That was an emergency message on all the cell phones over here. Yeah, so what we were saying was that the success of these sectors does not depend on any single factor. It is more of a secular tailwind that we are seeing. And now this is spilling over into other sectors also. Machine learning, machines are growing very intelligent because now they are able to process images and come to conclusions which they were not able to come in the past. So autonomous driving, drones, all of this. Recently, there was a Mythos, that is the name of a model that was introduced by Claude, which just can go ahead and find all the vulnerable security risks in all the computers around the world, right? So it is generating new opportunities as well as risks. So it's truly the fourth industrial revolution. We truly feel that this is going to continue for a long time. There are so many applications, so much growth that is still there. We are just at the beginning of this cycle. So we don't feel that even if the market stays steady or give low returns for some time, we will definitely be higher than that. Now, obviously, how much higher, only time will tell. But I think we are very well placed for it. Go ahead, next question.
So we have a next question. How do you factor escalating US and China geopolitical tensions, trade restrictions, tech bans into your say, equity allocation, especially in sectors like semiconductors and AI?
Yeah, so I think the US and China, they are in a race in any field you take, be it geopolitics, be it currency, be it semiconductor, and they're going to continue. And this can go on for years, as long as they don't throw missiles at each other. Okay, if they don't fire missiles at each other, the market is not going to care. Obviously, if US or China, if they fired missiles directly at each other, all bets are off. That's a problem for the markets. But up to that point, I don't think nations always compete with each other. Europe competes with US, Russia competes with US. There is nothing to worry about from a market perspective. Sunil, you want to add something to the geopolitical points?
Well, I think that what my perception of the war itself is that it's a war for oil, right? Clearly, that's very clear because it was the next step after Venezuela for US. But that war for oil was necessary because of China. So this is a part of, how do you call, pincer movement, is you've followed the German Second World War, right? Is that you attack from multiple fronts just to distract the enemy, but your goal is the enemy. So China, which was main purchaser of Venezuelan oil, Iranian oil, right? So the war on oil that's why the US was willing to take a short-term spike in the oil price, but in the long run, they want what? They don't want to bring down China. They want to be on a good negotiating table with China, because the US and China, two things to that. One is China is the emerging superpower versus US is the existing. And by 2034, 36, China will overtake the US in terms of GDP. That cannot be changed. Now, the point is, and that's like Athens and Sparta way back, if you go back to the Greek world, right? How Athens attacked Sparta proactively. So because Sparta was growing, and without any provocation, they went and attacked Sparta. That was the Peloponnesian War. So you can read in the history about it. It's similar that the US is trying to it knows that China is going faster, China is likely to overtake. But in terms of the power, they are both interdependent on each other. And two simple facts here. China controls rare earth supply, which is critical for the semiconductor industry. Second, China is the biggest buyer of US soy and corn. So there is a economic part to it which will continue. So they will spar at each other. They will try to improve their bargaining position, and this war is also in US's mind. And Israel's the reason for the war is completely different. Okay, let's leave it out of the picture. But so China is critical as going to be the constant. It's the Cold War of the previous decades between Russia and the USSR and the US before the USSR broke up into Russia and other states. Is now the US China. The two poles and axes of control are there. And to complicate matters, we have the BRICS, which is the polarization around that. So why I'm saying this is that what Ketul says is very right, that this is a part of our reality. There will be skirmishes, there will be this tugging and froing, but there's not going to be permanent victor in this war. Now, obviously, if China tries to annex Taiwan, it's going to be a completely different dimension in terms of the US will definitely get into a physical war. So those are all, the what do you call the black swan events, right? So which we can't plan and prepare for. But that apart, being that you are going to see this tug of war continue. But overall, AI is something both China and the US are going to take forward. And obviously, Taiwan and Korea are important players in this. So from a investment and a markets perspective, it's just important to be aware of these and take cognizance of this. But they are not any reason to either stay away from the markets or to go all in terms of one country, right? You have to play your parts. And the Chinese market as an investment, it's still unfortunately a very closed economy. Entry into the Chinese stock market, exiting even through Hong Kong is not so easy. So that's something you will keep evaluating from Ketul's side. But clearly, in the AI revolution, the impact of that is going to be felt across the globe, and there will be investment opportunities from all geographies, barring at this point, it's sad to say India, because and clearly, as far as the Indian situation is concerned, we are struggling to become AI ready. And the primary reason for that, and it's not from a negative perspective, primary reason is India needs jobs and AI is anti-jobs. Right? AI is pro-productivity but anti-jobs, but we cannot just jump onto the bandwagon and hurt. So India is, while we may make some politically the right noises, and the reason the IT sector in India is getting hammered is because the fact that even the latest earnings season, the satisfactory answers were not forthcoming from the IT companies on how they are going to tackle this fourth industrial revolution, right? So, in fact, in a very drastic manner, I may make a statement, and maybe some questions will come because of it. My suggestion for international diversification and currency diversification, historically, IT has been the play for you to play the dollar strengthening, rupee weakening story, right? I would say that if you're invested in a mutual fund, you can't avoid it. 10 lakh crore plus of Indian mutual funds have exposure to IT. That will continue. But do not add additional IT sector exposure to your portfolio today, because IT has changed because of this whole thing from a growth to a value portfolio. So to the extent that you want value, okay, maybe you can consider it, but substitute your IT exposure outside of your mutual fund regular diversification, what they give you, into an international AI related exposure. That's the way forward, because Indian IT is going to suffer the consequences until some big dramatic move happens. Because we talked about the money, right? You can't, India can't go and buy even a small AI company. The cash balances, which look large from a rupees crores perspective, we will not be able to buy any AI company which has demonstrated its position in the marketplace. So I would say that don't add extra IT sector exposure to your portfolio. Instead, substitute it with AI oriented international portfolio. The same dollar strengthening effects will be felt, but you will also participate in the EPS growth of an AI ready company instead of suffering the negative consequences of market punishing IT here because it's not AI readiness. I'm sorry, that was not the question asked, but I just went from the flow of your question to that answer from my perspective. But I didn't see a question around what do you expect around the rupee depreciation. This partly answered.
No, no, wonderful. I think it's all very useful. Prashant, go ahead.
Okay, so we
We
have
have
another
another
question.
question.
With
With
US
US
market
market
heavily
heavily
driven by a
driven by
few
a
tech
few tech
giants, how
giants,
do
how
you
do you
manage
manage
concentration
concentration
risk?
risk?
Fair enough. Yeah. So I think all markets, if you see, there is concentration. US is in fact not that concentrated. It is concentrated, but if you look at other markets, say South Korea, two companies that are generating all the returns. Taiwan, one company. So, I mean, I'm giving examples which are on the other end, but US being concentrated, it is concentrated among 10 large companies. And these large companies have very transparent accounting standards. Everything is quite fair and easy to evaluate. So it is not like all of a sudden we wake up and we realize that there is fraud going on in this company, because we get quarterly statements, we see their revenues, we see their order book, we are seeing everything on a live basis. So one part is that it reduces that type of risk. These are very well professionally managed companies. So typically you get into issues when you the there is an accounting statement issue, there is issue with the order book or anything of that sort, which is not disclosed. But here, not only that company, you have five competitors who are disclosing their order books. So by the time, say, if Google is giving out their order book, people immediately make assumptions about Microsoft. People make assumptions about Amazon's order book, about Anthropic's order book, about OpenAI's order book. So they are all, people are comparing them to each other. So it's not like we are operating in a vacuum. And that's why we feel that a little bit of concentration may not be a problem also. And the other thing is, these companies, the size of these companies is large enough that you can invest more and concentrate. If you were talking about $1 billion company or $500 million company, and if you are concentrating in that, then that is a very totally different risk. But if you're concentrating in a $3 trillion company, the risk over there is very low compared to a $1 billion company, right? And so if you're concentrating in some of the large companies at decent valuation, I'm not saying invest at 100 PE multiple. If you are investing at decent multiples in a $3 trillion, $5 trillion company, then that concentration has far lower risk than you taking the same position in a $1 billion company or a $2 billion company. So concentration in large companies is way less risky. And secondly, Sunil, you want to say something?
Yeah, no, if you're done, I just want to add a couple of points to what you said.
Yes, go ahead.
So one is that you had it in one of your slides. I just point it out that the concentration in the US biggies is not a concentration on the US economy, because significant proportion of these companies' revenues come from outside of the US. So you are actually diversifying geographically by concentrating on these companies, right? You just that is. I saw it sometime back, but I saw that I think more than 35 to 40% of S&P 500 revenues come from outside. Now, individually for these companies, it will be much higher proportions. In fact, US is not their dominant market. Okay, they get more sales from outside the US than the US. So why I'm saying this is, you are actually, if you want to play AI in every part of the world, the company is listed in the US, unfortunately. Right? So the point is that you're maybe concentrating in the US stock market, but that is reflecting the growth of both sales and profits from the whole world. So your best aspect of diversification is to concentrate on a globally diversified player, regardless of which market he's focused on. So you talk about Taiwan and TSMC, his sales are from everywhere. It's not the Taiwanese economy which is supporting his growth, by the way. So by investing in the Taiwanese company, you're not concentrating on Taiwan country. You're concentrating on the worldwide place. And so investors in these companies are also not from their local geographies. So understand that there's global capital coming to these companies because they are listed there. So their source of capital is also diversified. Whereas, to take a stark example, take India. Whether you like it or not, in the Nifty 50, banking and financial services is 35%. In the Nifty 500, it's 25% plus. So in India, you are concentrated in the BFSI space, whether you like it or not. That's a far greater risk that you are taking, because these are all geographically within India. And within India, you are not only concentrating in India portfolio, but within India, concentrating on BFSI. So anything that happens on interest rates affects a whole portfolio because it's rate sensitive. So the point is that the word concentration, right, has multiple meanings. It is far more risky to be concentrated on India and within that to BFSI, which you have no choice but to avoid if you're going through the mutual fund route. The mutual fund exposures are also of the same 35% order. Take the mutual fund or any diversified mutual fund, it's concentrated in BFSI. So true diversification comes from a geographic stock market diversification, but more importantly, geographic sales diversification of the companies that you are buying in. The banking system, India has very poor location outside of India. So it's doubling down your India concentration risk. So I think that's the point I wanted to make, that understanding diversification concentration needs one level below to understand what is the true, if you take a portfolio, what is the sales exposure to the rest of the world. That's what is ultimately going to drive your returns, right? Yeah, that's what I want to say. Ketul, you're muted.
Yeah, so that's the chart that you were talking about, Sunil. It's on your screen right now. Only 52% of S&P 500 revenues are from the US. 48% revenues are from outside of the US, and these are S&P 500 companies. So our companies are even more geographically diversified. I know off the top of my head that Netflix has 58% of its revenues from outside of the US. So you can imagine it's not dependent on US to the extent some of the companies are dependent on their home countries. So that's the point I think Sunil was trying to make. Wonderful. Next question, Prashant.
So we have the last question.
Just 1 minute. Prashant's questions are getting echoed. So maybe Ketul, you can look at the questions and you can ask it. I think his mic is echoing.
Okay. All right. So I see one question over here is if all the valuations are low, then is there systemic risk brewing up in the system? And finally, will that hit the reality? So that's a good point, that either one of the two things should happen. Either the valuations should improve or the earnings should come down, because there is a mismatch. Now, you have to bet on either one of them. We are betting on the fact that earnings will continue to grow because there are fundamental reasons. We are going to use the software. There is growth in token usage on the AI end. As long as we keep seeing that, we will be confident that earnings are going to grow. If that stops, then the other scenario could come into play where earnings could start sliding, and then these valuations would look expensive. So what that question inherently implies is that will the earnings go down? And in that case, these valuations, which are based on earnings, they move from being attractive to being expensive. So that's what the implied question is. And as long as we see the earnings growth happening, and we don't wait for the quarterly earnings, every day we keep a track of what type of growth we are seeing for the company, what type of usage growth we are seeing on the AI, and we have multiple signals that we keep track of. So it's not like all of a sudden after 3 months we'll come to know that, oh, oops, these companies are not growing, right? That's not going to happen. So as long as the usage of the services that these companies provide keeps on growing, the earnings will keep on growing. And in that case, the low valuations they'll not stay, because obviously the stock prices will move higher and will give returns. And the other scenario will not happen, where stock markets start looking expensive because the earnings went down. So I think that's what we have to keep checking, and that's what we do on a minute by minute basis. Actually, every day we keep a track of how the companies are doing, how their earnings are expected to do, how their services, how their products, what is the innovation going on in their products. If they stop innovating, that's also a problem, right? IBM used to be a great company. They stopped innovating 20 years back, and now you see what has happened to them. It'll keep lingering around, but the stock price doesn't do anything till you see some activity in terms of new products, new growth happening. So we keep track of that on a day-to-day basis, and as of now, we are not seeing any risk to that side of the equation. Sunil, you want to add anything?
I just want to add that there are two scenarios, right? That is the low valuation, the market telling us that they don't expect earnings to happen, right? And hence you'll say, do you want to bet against the market? The second aspect is, if you look at it, that the valuations are low, and if you are buying growth-oriented companies in the stocks, then the valuation gives you a margin of safety. So it can't fall further. So when you construct a portfolio, the worry is always when valuations are high on, is the market's expectation of growth going to be justified? But what a valuation low is telling you, that the market is not expecting the growth. And if you're able to use a stock selection process where you filter out growth, then you are actually playing in a margin of safety field, right? Where, because you have analyzed the growth of that underlying company, you are contributing against the overall valuation expectation. Because could be other companies which are slowing down much faster, which the market is taking, because the market is a weighted average of the weightages of the various stocks in them. So it gives importance to that weightage. Whereas in a portfolio selection, you don't care. That's why you overweight a certain sector stock and underweight a certain sector stock. So in building your portfolio, right, if you are then in a low valuation scenario, searching for growth and finding and investing in it, then your margin of safety is actually much higher. Whereas if the valuations were high and we were talking and we are saying this growth, the market is already betting on that growth company. And unless you get your growth bet faster than the market's growth bet, that is where you're in risky territory, right? So I would say you have a margin of safety, and I would be much happier in this situation, right, rather than in the other situation.
Wonderful. That's a wonderful point. I totally agree. So yeah.
So we have another question.
Prashant, just pass it on to Ketul. Your voice is echoing.
Okay.
I don't see those questions over here. I think he's received them directly, but
Now my voice is perfect.
No, your voice is echoing. Ketul, are you hearing it? I feel echo.
No, I'm hearing it perfectly fine. Go ahead. I'm not hearing the echo.
Fine.
Hello.
Yeah, go ahead, Prashant.
Yeah, so we have this question: how do you manage downside risk in a volatile markets?
Yes. So downside risk, one is obviously you reduce the beta of the portfolio, which means beta is the measure of how much your portfolio goes up and down with respect to the market. So beta of 1 means you will go up and down exactly in line with the market. If the beta of your portfolio is 1.1, that means you will, if the market goes up by 1%, your portfolio will go up by 1.1% in line with that, right? So that's the beta that we manipulate to keep our risk positions within a certain level. That's one thing. The other thing is we manage the concentration levels of the stocks that are there in our portfolio. So if a highly volatile stock, you will always see that it will be at a lower concentration in the portfolio versus a more stable stock. We can allow it to go to a slightly higher, say 8% or 10% of the portfolio also. So that's how we manage the risk and volatility in the portfolio. Obviously, shorting the market is the best way to reduce your volatility, but we are a long-only portfolio, so we do not short stock, and Indian investors anyways are not allowed to short stocks in the international market. So that is not an option for Indian investors anyways. Go ahead. You want to add anything, Sunil?
No, nothing. That's fine. Perfectly.
Yeah. Go ahead, Prashant. Anything else?
No, sir, we don't have any question.
Perfect. Sunil, you want to say anything before we wrap up the call?
I think that it's been pretty good, engaging Q&A today, and I think a lot of clarity has emerged because of the question. So thanks to everybody for doing that. This is what makes the whole presentation worth it, rather than just passively listening to it. So keep the questions going, and all the best. We will recommend this to all of you and those who missed it. Thank you.
Thank you, Sunil. Thank you, everyone, for joining us. And we look forward to seeing you on the first Saturday of next month, 11 a.m. again. Till then, happy investing. Thank you. Bye-bye.
Thank you so much.